Good evening, everyone. Thank you for joining us this evening to talk about why finance matters, and in particular, how this relates to our incredible female doctors. My name is Jackie Lombard, and I'm the head of the New South Wales team and co-founder of Kooyoung Group, which has recently rebranded to Avant Financial Services. I will be your host this evening. Let's just make sure our technology is all working. Right, so we would like tonight to be interactive, so please feel free to ask questions as we go using the Q&A button at the bottom of your screen. The lovely Cassandra will endeavour to answer as many questions as she can by the end of the session. This evening we will only be providing general advice, so should you wish to have a separate discussion, please feel free to reach out to any of us privately. Our contact details will be shared at the end of the webinar. While we wait for a few more ladies to join us, I'd love to share a little bit about who we are and how we came to be here today. I've been in medical lending for the past 20 years, the first 10 at Investec in South Africa, followed by another stretch in Melbourne, also with Investec. My co-founders and I left the business a couple of years after Investec sold their medical lending division to Bank of Queensland, only to be drawn back together again by a common set of values and beliefs. Much like doctors, what got us out of bed every day was a genuine desire to help other people. And so it made sense to help the people that help others, i.e. doctors. We deeply respected the time and energy, personal sacrifice, and financial commitment it took to become a doctor. And we wanted to continue supporting doctors in their journey and to help them be their best. We also wanted to build a business where people loved coming to work, because the way you treat your staff is the way that they treat their clients. And while we all really enjoyed working with money, we wanted to do something good with it. And so the Kooyoung partnership was born, money working for good. As luck would have it, a few months later, Avant Mutual, who were the biggest medical indemnity insurer in the country, reached out to us. With around 80,000 doctors as members, they wanted to take the by doctors for doctors one step further and use the funds they collected from premiums to help other doctors beyond insurance. The answer was pretty obvious to us. Why not use doctors' money to finance doctors into practices, with the resulting profits going back to the members rather than the bottom line of a big bank? For us, that really was money working for good. And this marked the genesis of the Kooyoung Avant joint venture in early 2020. We were 7 people at that stage, and over the next 2 years, we grew the business to 75 people in every jurisdiction across the country, and all that during COVID, and provided over $1.5 billion of loans to the medical community. In addition to being brokers, we have spent the last 3 years building our own bespoke lending platform, all from scratch, or as we put it in those early years, building the plane while we were flying it. And fast forward to today, we are now ready to go to market with Avant's very own lending products under the newly minted banner of Avant Financial Services. So watch this space. From a personal perspective, I've always believed that the world needs more financially strong women and have been passionate about working with female doctors, some of whom are on this call tonight. At the start of my career, perhaps 1 in every 10 clients were female. And thankfully, that ratio has improved tremendously over the past 5 years. And yet, the story parallels with female lenders, who remain few and far between, and even less so in the broking world. Over the years, I've made it my personal mission to seek out and nurture the brilliant female lenders I've come across. And tonight, I'm thrilled to introduce some of them to you. First up is the amazing Jordan York. Jordan has been an integral part of Kooyoung Group almost from the beginning. She's our top business writer and one of the finest residential lenders I've ever had the privilege of working with. Jordan is building such a strong personal brand that I have no doubt you may have already come across her in many of the online forums. She's going to talk to us about why finance matters from a personal lending perspective. So over to you, Jordan.
Thanks.
Sharing.
Thanks so much, Jackie. Let me just share my screen. Okay, wonderful. So as Jackie said, my name's Jordan, and I'm one of the relationship directors here at Avant Financial Services, working primarily with doctors in New South Wales and the ACT. As a female doctor, throughout your career, you'll need various types of finances at very different stages, and I'll be covering off the residential part of that finance, which is also known as home lending. So let me quickly do that. Perfect, we're up and running. So residential lending is property related. So it covers off properties that can be lived in by yourself or someone else. So you'd be thinking your home, a holiday house, or even an investment property. As a doctor, you're quite attractive to a bank because it takes you so long to qualify, as well as I said, the lending that you'll need throughout your career. Because generally, accountants will advise to purchase property as a part of your tax structure. So, this is a high level of what the banks would offer and what we regularly do for our clients. So, for owner occupied properties, you'd be looking at 100% borrowing as a maximum with no lender's mortgage insurance. For investment properties, this is slightly less and it's sitting between 90 to 95%. Now, for doctors, this covers off purchases, refinances, as well as your other types of finance like constructions, equity releases, or bridging loans. Now, we won't be covering off what these are in depth, so if you have any questions, feel free to put them in the Q&A box, or you're welcome to speak to one of our advisors after the presentation. Now, for our hospital-based doctors, but in particular our public doctors, there are banks out there that will do some funky things to assist with your borrowing capacity. Now, this can be using your future income plus 100% of your current overtime and allowances. So as an example, if you were a PGY4 doctor, what we would be able to do is use your PGY6 base wage based on your relevant state award, plus 100% of your current overtime and allowances. Now, what this does is it allows you to increase your borrowing capacity to potentially increase your purchase price. Now, this obviously helps our doctors in the more expensive areas or those that are in their more junior years that are trying to purchase a home that's going to suit them long term. Now, for our self-employed doctors, there's some pretty sexy stuff that we can do for you too. So we'd be looking at minimal history for self-employed, newly private, assisting and locum doctors, which I'll cover off in a little more depth later, as well as looking at 1 year in isolation for our more established self-employed doctors. So if you'd had one really good year in the last 2 years, we can look at that one as opposed to the downturned one. In addition to that, we can also work with your accountant to provide facilities for deductible business purposes. Now, this is a little more specialised and nuanced, so we would be having a chat with you and your accountant either in person or over Teams just to make sure that it's more suitable to you and covering it off in a little more depth. Now, what we're all here for. So as a female and as a female doctor, there are a lot of things that we can face when it comes to obtaining finance, and some of them are quite unique. So the most common questions we get when we're doing a female webinar is related to bubs and maternity leave. And the most common question is if the banks will even lend to you during this time. And the answer is yes. Generally, home loans are over a 30 or a 35-year term. So it'd be very strange if the bank thought that you would be popping out a baby every single year of that term. So they generally won't judge you based off 1 or 2 years of downturn when they'd be considering lending to you over that full 30-year term. So what I would say though, is it can be a little bit tricky because you want to be going to the correct bank and presenting the correct information. So having someone in your corner that understands doctors, maternity leave, or returning to work, depending on what stage you're at, as well as what you're actually after lending wise, is going to be really important because we will ask you the correct questions and then present it in the correct manner to said bank. So as a PAYG doctor, the banks will generally look at a return to work letter, which will be issued by your employer. This generally has a date that you'll be going back to work, as well as an income level, be it which year you are or an income figure, and the banks will lend based on this. As a self-employed doctor, it can be a little more tricky on top of that. Generally, we would look at the last full year of history that you've had, so a tax return, and depending on the timing of that, we may need some additional information from your accountant to support what the banks will actually need. Now, if you're on maternity leave or going to be on maternity leave, the banks will want to make sure that during that period, you can still afford to make repayments as well as live. So generally, there's a calculation that we do to make sure that you have sufficient savings to cover your repayments during this period. And we'll normally add a buffer on to make sure that you can afford to live as well, because you don't want to put everything into the mortgage and have nothing for coffee dates, lunches with the girls, and generally lots of baby related things. So it's generally straightforward outside of this. As long as you've got someone that understands you as well as what you're after, that would be the most important thing. Now, generally during this time, we see our ladies want to complete renovations that they've been putting off to their property, or even upgrading a home or buying their first home. So we would say it's really important to do this towards the beginning and not leaving it to the last minute, because it just will create a lot of stress. And it also means that it's a lot easier for you because it's not going to be stressful with a time crunch. In addition, we see a lot of our ladies planning ahead of time financially for having bubs in the next few years, or how they're actually going to pay to do so if they know that they need IVF or other type of support like that. Again, we're always happy to have a chat with our doctors. We can put in place a savings plan or even a lending plan, and having a chat about what goals and savings we need to hit beforehand so that you can be comfortable and your partner can be comfortable during that period. Depending on your complexity, a financial planner might also be someone that we advise speaking to, because there can be other factors to consider. Now, as a doctor, there's other things that we need to take into consideration outside of bubs. So we'd be looking at specialty training or transitioning from PAYG to self-employed. Now, assisting our doctors during this transition in their employment is where we add a lot of value, because generally banks will want to see 2 years of history as a self-employed doctor to be able to lend to you. Fortunately, because we have our own teams within all the major banks, as well as we're quite familiar with medical structures, you'd actually only be looking at 3 to 6 months history to be able to get a loan. We've actually done less than that for some of our doctors, but it very much depends on what billing information, invoices, and structures you have in place. So this would cover our doctors that are transitioning into private practice or locuming, either through an ABN or a company, or any type of surgical assisting under that. Now, it's really important that you do have someone that is a medical lender for this, because otherwise you'll be going to the banks that want 2 years of history, and it's going to be like beating your head against a wall. Now, for our doctors that are completing their specialty training, there can be change in structure considerations like for what I just discussed, but there can also be some other things that we need to consider, like a downturn in income, which might mean that you need a loan to cover off cash flow during that period, or you might be moving interstate or to another city, and you might be considering starting your investment portfolio by buying a property that you'll only be living in short term that'll become an investment property in the future. Generally, what we say to our doctors, because most of our ladies are planners, would be getting in touch as soon as you get on a course with your advisors, so that we can come back to you with options that would be suitable. So then you can make a decision on what makes sense for you, whether it is buying or renting, or what kind of price range you're looking at, or even what type of finance options are available if we are going down the route of a cash flow loan or an equity release to fund any type of downturn in income. Now, the unfortunate one that we've been seeing a massive increase in since COVID is relationship breakdowns, and it's prevalent for our doctors that are both married and in de facto relationships. So no two situation is the same, unfortunately, so it's really hard to provide any generic guidance on what you should or shouldn't do. What I can say is having someone that's experienced in medical lending and that just generally understands what you're going through is going to be really important, because more often than not, there will be some type of finance requirement within this. I think out of the last 10 divorces that I've worked on with my female clients, 7 out of 10 have tried to keep the family home and have needed finance assistance from a lender to be able to do so. So by having someone in their corner, it means that they can make that not necessarily our issue, but it's something that they don't have to worry about, because they know we've got it covered for them and come back to them with what they actually need to do in that time. In addition, we're seeing a lot of our ladies that were divorced a few years ago start to buy their own properties, and it can be a very scary time to get back into the property market. So again, having someone that's available for you, happy to be there 24/7, and again, understands doctors and lending and can make it understandable for you, is going to be really important. We're a resource that we want to be used, and we want to help you. And generally, your success is our success. I can't tell you how many times Kate, Jackie, and I get probably more excited than our doctors when they finally get a home and they do it by themselves, because it really is a massive milestone. Now, I'm sure you've heard me mention several times either a team of advisors or your network, and it really is massively important for our doctors. These people play a massive role in your financial success and wealth generation throughout your career. So it's really important to pick people that are experienced and medical focused, I cannot stress medical focused enough, but also that you get along with. You'd be surprised how many doctors we actually speak to that have these people and haven't spoken to them recently, which is crazy because we're all here to provide you with advice in our fields. So I've split this into MVPs and other advisors. So MVPs are the people that you're going to be speaking to regularly, so at least once a year. And then the other advisors are people that are going to be helping you on a needs basis. So as something pops up. So your accountant goes without saying, everyone has to do taxes every year. If you're self-employed, you'll be speaking to them much more than once a year. Now, it's really important that you have someone that can grow with you. So if you're a junior doctor, don't think that H&R Block is going to grow with you, because they're not. They make a very big difference in what you can claim on your tax return, what you pay in your tax, and this is from strategies and structuring. So very important to be with the right person. Financial advisor and planner is someone that we commonly see missing for our female doctors, but most of my male clients actually have them. And these are the people that are the glue between your accountants and your financiers. So they cover off pretty much everything outside of lending and tax, which is investment strategies, insurances, tax minimization, and they're the ones that can help you cash flow wise to live how you'd want to live. With the specialist financier, these are people like myself. I think I've covered this off sufficiently, but it's really important that you pick someone with a medical background, because it's going to impact how much you can borrow, when you can borrow, the rate that you borrow at, and as well as how difficult it's going to be to obtain finance. And again, the other two, if you have any questions on that, you're more than welcome to put it in the Q&A box. So if I can stress anything, it's really, really important that you have the team in your corner that really gets to know you. So I'm going to pass it over to Jackie so that she can cover that off with you guys.
Thank you, Jordan. And now I would like to introduce our second speaker, the fabulous Kate Farley. I was very fortunate to cross paths with Kate during my brief solo stint as a broker before joining Kooyong, or AFS as we're now called. And Kate was working as a health lender for ANZ at the time and was an absolute lifesaver on many occasions for my clients and I, which made her an obvious choice to come and work with us at AFS. So Kate's going to talk to you about the unique challenges faced by female doctors in business. So over to you, Kate.
Thank you, Jackie. And I'm always anxious before these types of events, because anyone who knows me knows technology is not my friend. So apologies if this is slightly clunky. So there we go. I think that might be working. There we go. Okay, thank you for the introduction, Jackie. So I'm probably giving away my age here, but basically my entire career has been in the financial sector. So I started out in ANZ in their mortgages area before moving to private banking, which is a lot of wealth protection and growth and that kind of thing, before moving into commercial. And then when ANZ started their health proposition, I was part of the early team there before being very lucky to join what is now known as Avant Financial Services nearly 2 years ago. So that's a little bit about me. So one thing that does come up a lot, and what I have noticed in my time working in the commercial space, so helping clients setting up medical practices, or even just expanding existing ones, or revisiting what they've already got and maybe having a review of how their current practice works, is that it is very different, male and female. The conversations that I do have, it does, look, I don't want to come across like I'm generalizing, but it does feel like female applicants or female medical practitioners, when they're looking to move into private practice, there's a lot more due diligence that is completed. There's a lot more research before starting out on a practice. And that does have that tendency where you want to find out about everything. However, and that is wonderful, and I don't want to discount that in any way, but you can't be a master of all trades. So it's understanding that there are going to be some knowledge gaps, and what are those knowledge gaps, and have you perhaps got contact points that can help you with that moving forward, just so that you aren't spending a lot of time that you could generally do other things and be more productive doing it. It could just be that you'll increase your own personal billings to fund that person to assist you, is another way of looking at it, and just to help you get to your planned execution much better. So your schedule and availability is always something to consider as well. Different life points as you're starting out, you might have family commitments. As you're progressing, you might be a more mature age and deciding to go out on your own at that point. It could be that you just don't want to be working 80-hour weeks. You want to have something that fits in with what your requirements are, but also have something else to show for it as maybe you transition from face-to-face billing and actually having your own practice. Could just be a commercial side. So it's understanding what you want to achieve, how you want that to impact your lifestyle as well when you are looking to move into private practice. As what Jordan alluded to earlier, there's a lot more concern around what supportive team that you have. So there is a lot of, an accountant isn't an accountant, it's an advisor. It's someone who works with a dedicated list of their own clients. They know the industries of their client base. So if you don't go to an accountant, for example, or a financial planner, an advisor, a lawyer that is familiar with the medical community and what the fairly common challenges you face are, then you might find yourself having to spend time educating them as to what you need done. And then you're not really getting the advice that you deserve. So it's knowing who to contact. It's quite a small industry. So I find, and Jordan's the same, we end up crossing paths with very similar groups of people over and again. And we know who is good to work with and who is accommodating for their clients, and then who might drag the chain just because, for a variety of reasons. So that's a big part to know. So when you're looking to start, acquire, or even buy into an existing medical practice, these are the things, and I've obviously already touched on this, is trusted accountant. So having medical industry experience. So the big part of that is, especially if you're starting from scratch, is understanding doctors' billing structures, setting up the financial side, conducting stress tests. So are you being realistic around what you expect to earn from setting up this practice? Or potentially, and this comes up with female doctors, no, don't want to offend anyone, but it does come up, the billing might not necessarily be in line with market. It could be that you're just spending more time with patients than your male counterparts, but more often than not, it's just you're not charging as much, just different people. But it's one of those things where if you've got plans in place from the very beginning, you've got the right advice, you can set up the correct billing structures in place, so you're not actually charging less than your other counterparts that might be in the area and impacting your profitability. No nonsense lawyer. You want someone who kind of gets to the point, gets there quickly, and is able to assist you in setting things up properly. And that could just be a new partnership, a new practice, or if you're buying into a new one, ensuring that you are well protected and that you're not subject to some onerous conditions that could impact you down the line. There's some interesting clauses that have come up in my time that could have meant that the client was liable for ongoing expenses. There's issues around whether or not there's independence of that advice as well, potentially, if the lawyer is representing both parties or multiple parties entering into the same transaction. So you want to ensure that the advice you're getting is legitimate for what your circumstance is, but also that they have your interest at heart. If you're getting legal advice from someone else, somebody who's representing your business partner as well, how do you know they're giving you the same advice that they're giving them? So specialist financial advisor and broker. So we often work with financial advisors and accountants to help clients set up their funding requirements in line with what their key objectives are. So there's a lot of crossover in what we do. It could be that we've looked at what their situation is. I've seen some interesting structures over the years that didn't make sense and had to refer them to a different accountant to get it cleaned up. It's very hard to fix something once it's already done. It can be done, but it's much easier just to set it up correctly. So practice loans, they're different from home loans. So it's commercial. Commercial is very interesting, and it also creates a lot of opportunity because what you can actually do depends on the lender. So if one lender might have a priority to specialists or surgeons, another one might be give priority to dental clients. It just depends where you go. I know pharmacy is a very unique one where only a couple of lenders are quite good. So it's one of those things where if you have a good broker or a financial advisor that can point you in the right direction, you're not wasting time making 10 phone calls to each lender to understand and then having to educate yourself on the policies as well at the same time. It could be as simple as they want to take an additional asset, a additional property as security when you know another lender will exclude the family home. You don't need to tie it in with your practice. Those kinds of things are really crucial to understand and to be able to get on the front foot there. Because if you can keep your personal assets separate from commercial or practice assets, particularly if you are looking to buy in with other partners or be open to other partners investing longer term, this is really, really key. Just to point out though, if you've already done it and you've already got the house tied in, or you've already got some intertwining of assets with your commercial and your personal, it's never too late to try and unwind that. So if you think that perhaps the structure that might have suited at the time that you took it is no longer suitable, you can always review that as well. You're not locked in. So what can you borrow when you're financing a practice? So you're lucky, you're in, like what Jordan alluded to before, you're in a really good industry. There's a lot of public data around what each modality will earn, and it's just, there's public funds involved. Everyone needs to see a doctor at some point. It's one of those things where everyone's jokes, it's recession proof. Of course, you know, there's always some slight impacts, but it's a very good industry to be in. So if you're buying a practice or setting one up, you can lend up to 100% of the practice value. Same with equipment, fit out, vehicle, commercial, basically 100%. It's the way to go. So I will just clarify with the commercial property, that's for you to practice from. It's not you want to buy a commercial property and just have it as a standalone investment. It needs to be tied to what you do for your work. So what can you do? The best option is always plan ahead. You might think, oh, I'm not looking to do anything for 2 years. It's too early to talk, but I actually think that's the best time to, because you don't know whether or not you need to be starting to put plans in place right now or getting structures set up now to help you achieve those goals longer term. There's a lot of lead time to things. It's quite common where we've been talking to the same client for maybe a year or two before it actually gets to the point where they're doing the build or they're doing the fit out or they're setting up a second practice or having partners buy in. It's a long process sometimes. So even if you think it's too early, it's better just to have that chat. Worst case, you've just put your mind at ease. You've had a 20-minute, half an hour discussion about what you're wanting to do. And either you need to do something right now, or we can just pencil it in that we reach out at a future date. Speak with your accountant. So making sure that you are set up properly. I've seen some interesting things set up. So it's always good. Again, if you have a chat with us, if you're unsure around what you've got set up, we can maybe have a review and see if it actually makes sense in the context of what we see every day with other clients. Speak with your lawyer. And again, if you're not sure and you need to be put in touch with someone, just have a discussion around what you're planning to do, and then they can give you some advice around the best structure, best way to move forward. Or if you're already established and perhaps having some difficulties there, then they can give you some advice around perhaps remediating that as well. I work with your team. I've introduced clients over the years to many different support networks, whether it's an accountant, whether it's they're getting a fit out or a build done, they needed a project manager or they've needed a lawyer. It's something where we often step in, buyer's advocate, to help them scout a correct location for the practice. The worst stories are when I hear of clients, they've purchased a property that's not fit for purpose. They've spent a lot of money trying to figure out a way to make it work. Doesn't work. They've got to sell it. They've lost all that time, all that money, and they've got to start again. So buyer's advocates definitely very useful if you are looking to set up a brand new practice in a new location. So final thoughts. Everyone's circumstances are different. So always just have a chat, see what your situation is, and perhaps we can steer you in the right direction. What our job is we're here to help you navigate through this whole process. So whether it's right at the beginning, you're in the middle of the process, or you've already had something done and you just like to sense check it, make sure it's the right one for you. It could even just be to check that you're actually paying competitive interest rates, or you're on the right structure. Different banks have different loan terms for commercials. So some can put clients on pretty onerous loan terms to have higher repayments, and given the way rates have gone, what was working before may not be working anymore. So it's always good just to review and see if there's a way to actually improve that for your current circumstance. So what you can do is you can inquire with Avant Financial Services to discuss your specific situation, personal and professional goals. So we're based in every state. So yeah, if it's not myself reaching out, it could be one of my colleagues interstate as well. I'm based in Melbourne. And there's my details. So if anyone would like to reach out, hopefully you're pretty quick to write it down, but you'll get all the details later on anyway. So I hope you found it beneficial. Thank you.
Thank you so much, Kate. Partnering with Avant gives us access to wonderful professionals like our last speaker, Jennifer Jackson. As Avant Law's partner and head of estate planning and probate, Jennifer will guide us through the means to safeguard ourselves from the unfortunate life events we'd really rather not contemplate. So over to you, Jen.
Thanks, Jackie. And welcome everyone. So I'm here to talk to you all about business asset and structuring. So Jordan and Kate have talked to you about getting finance and, you know, perhaps starting a practice and building up your assets in that regard. And I'm here to talk to you about protecting those assets as you go through life. So as Jordan said, as Jackie said earlier, it's just general advice that we're giving tonight, but I'm always happy to talk to you individually if you wanted to contact me. So tonight, the main things I'll be going through are the ways that you can own your assets, how you can protect them during your lifetime and also after your death. So in this session, I'll be covering the different options for asset ownership and structuring and what that means in terms of how you can control things if you lose capacity or if you die. Protecting the assets from relationship breakdown or bankruptcy, so during your lifetime. And then the use of trust during your lifetime and also after death as just one way of being able to protect your assets. So the next slide, I think, is one of the most important ones, and that's really getting an understanding of how your assets are owned. So how they're structured, how they're owned is going to have a really big impact on how they can be dealt with and who's going to control them if you lose capacity or after you die. So basically every asset that you own will come down into 4 types of structures. So think of them as silos or columns. So there's assets that we own solely, so typically like car, personal belongings, and you might own property in your sole name, or you might not. So assets, anything that you've got in your sole name, bank accounts, things like that. Now they're controlled by you whilst you're alive, and then by your will after your death. If you've lost capacity during your lifetime, they might be controlled by your attorney if you've got a power of attorney in place. Then there's jointly owned assets. So that's, you know, if you think typically of a house that you might own with a partner, or a bank account that you might own with a partner, joint bank account, that's where you treat it as one person. So you're co-owning it during your lifetime. And then when one of you dies, the one that's left, so the last person standing, they're the one that will own it then solely. It'll move into their solely owned column. So that can be a way that you can protect assets by not owning something just in your sole name, but having it perhaps jointly or in the name of someone else. But that's got things that you need to consider as well. Then there's superannuation, which is often nowadays one of the largest assets that we end up with, you know, later in life. And there's restrictions on how you can access it. You need to meet a condition of release, approaching retirement, or having some sort of medical condition yourself. And there's also limits on who can inherit. So there's restrictions around who can receive your superannuation after you die. And then there's trust. So typically there's family trusts. There's also unit trusts and companies and things like that. But with unit trusts, there's units that need to be owned in one of these structures. And with companies, there's shares that need to be owned in one of these structures. So a family trust is a discretionary trust, where the trustee is usually the person that has complete control on who can get the income and capital from that trust. And I'll go into that a little bit more detail in a following slide. So the next slide that I want to talk to you about is, the next couple of slides, is how we think about how we deal with assets, asset protection situation. And as Jordan alluded to earlier, relationship breakdown is unfortunately quite common. You know, they say, I think it's 1 in 4 marriages end in, no, more than that. I think it's 47% of marriages end in divorce, you know, throughout someone's lifetime. So it's about how you can deal with your assets if you find yourself in that situation. So obviously, if it's an amicable breakup and you can agree to whatever you like as to how you split up your assets. But if it's not amicable and you end up in court, the family court has really strong powers about how assets will be distributed, who's going to get what assets, and they can make a decision. And it might not always be what you're expecting or what you would accept as being fair. So one of the ways that you can work towards making sure that there would be a fair separation, or something that you and your partner are both in agreement with, even if it's grudgingly, is to have a binding financial agreement in place. So we abbreviate that to a BFA. So having a valid BFA in place can't be overturned by the family court. So it's binding on the family court, and it's binding on each other as well. So it creates certainty about how your assets are going to be dealt with if you were to break up. So probably most of you have heard of a prenup, and that's just one type of BFA. So a prenup happens before the nuptials, so before marriage, but you can do binding financial agreements after you've been married or after you've actually separated if you still have a mind to do that. But they can also be used by de factos as well, so you don't have to be married at all. So one of the important things to make it binding is that both parties must get independent legal advice. They have to have separate lawyers who give them independent legal advice about the pros and cons of entering into the agreement as it's being prepared. And then the lawyers independently sign that after having given the advice, and that's what makes it binding on the family court. So if it's not valid, then the court can just ignore it or overturn it. And the parties must enter into it freely. And so that means you've both got to have information about exactly what the assets are. You can't sort of hide assets and squirrel them away. Otherwise, that can be something that would make the agreement invalid. And it doesn't have to cover all your assets. It could be limited to just specific assets. So it might be your medical practice, or it might be an inheritance that you've got and you want to keep that on your side of the family, something like that. It could be about a particular scenario about care of children and all sorts of things. So you can agree to whatever the two of you agree to, and as long as you get that independent legal advice, it will be binding on the court. And because of the complexities and the need to make sure it is binding, otherwise it's not worth the paper that it's written on, is to make sure that it's prepared by an experienced family lawyer. So at Avant Law, we don't have a family law division because a lot of doctors marry doctors, and so there'll be lots of conflicts, but we can certainly put people in touch with good family lawyers around the country that we've worked with in the past and still refer to now. So we can always assist in that regard. So another form of asset protection is making sure that, if you are in an area of medicine where it's perhaps higher risk than other, different practices have different levels of risk, or your appetite for risk might be higher or lower. That's a very individual thing. So protecting your assets from bankruptcy. So again, how you own your assets, going back to that first slide with the columns, how you own your assets is going to depend on how you can protect them from bankruptcy. So assets you own in your sole name, they'll be vulnerable if you're made bankrupt. So a trust is one way. It's just one way of protecting your assets from bankruptcy. There's other ways, like assets put into superannuation can be better protected until you reach retirement age. Having assets in the name of a partner or jointly owned is another way that you can protect assets as well. So you've got to get advice about your particular assets that you're trying to protect and the ownership structures that are going to suit your circumstances. But a trust is one way, and the reason being is because the legislation, the Bankruptcy Act, says that property held by a bankrupt person on trust for another person is excluded from being property that is divisible amongst their own bankrupt, their own creditors. So if I was to go bankrupt, my personally owned assets would be at risk from the trustee in bankruptcy coming in and trying to get my assets to pay creditors. If I'm holding assets on trust, so if I'm the trustee of a family trust, holding them for another person, a class of beneficiaries, then that's going to be separate. That's not going to be part of my bankruptcy. So looking at a family trust, so typically you would have a trustee. It can be individuals, it can be a company. There's often another role, and that's often the main beneficiary, the primary beneficiary, and they can hire and fire the trustee as they see fit. There's usually a really wide class of beneficiaries, so a primary, the spouse, the children, other relatives, any charity in the world, other companies and things that they're involved in. So having that wide class of people that it can benefit, that's what gives it the asset protection. And there's also the income streaming opportunities, because whoever gets the income pays the tax at their marginal rate. Children under 18 can't get particularly good tax benefits. They can only get a couple $100 a year, and once they're over 18, obviously they get adult tax rates. So the unallocated assets that are just sitting in the trust, they're protected, and it's another way of keeping your assets separate from your business. So you might have a family trust that owns lifestyle assets like a holiday house, and you've got your business assets held in a different trust or in some other ownership structure. Or it might be that it's your family trust that holds your business assets, and you're keeping all your home and your lifestyle assets separate away from that family trust. But in looking at all that, you've got to consider there's tax implications and stamp duty implications and so on that need to be considered and managed. So that, again, is where it's great to have your advisor, your accountant, your financial planner, and so on. So the other things to think about with family trusts is that, again, the beneficiaries don't own the assets in the trust. So you might think of them as your asset, but it's actually the trust that owns it, the trustee that controls it. One trust might not be good to use for owning a business where they've got multiple business partners, but it could be that you have a number of trusts that can own part of a business. So the next slide has an example of that. So you might be you, and you might be going into practice with other people, and you've got your family trust set up, and there's partner B and partner C, and they've got their family trust. And each family trust owns units in a unit trust, or it might be shares in a company that owns the business. And you can decide how you're going to own, what percentage of the business that you're going to own via that unit trust. So this is where having a unit holders agreement is going to be really important to deal with your incoming and exiting partners. What happens if someone dies? What happens if someone loses capacity or wants to just sell out? Something like that. So having an agreement where everybody understands exactly how the business is going to be valued and how people can come and go. And so that's where, like at Avant Law, we have a commercial department which can assist with things like that, setting up the structures and also doing the agreements. And thinking about, as I said, if you're going to die or you have a total and permanent disability and can't work, how that's going to be managed needs to be agreed upon. Now, thinking about how to protect your assets after death. So you've spent a lifetime building up your assets, and how are you going to protect those assets for the people that you want to leave them to? So I've just got a quick little scenario. We've got Megan, who's a doctor, and she's got 5 people that she wants to benefit. They might be children, they might not be children, they might be friends, but they've all got their different sort of issues that she wants to make sure they're protected. So Brian's fairly stable. So with all of these, we're talking about having a testamentary trust in your will. So it's just a type of trust. Testamentary just means it's in your will, and there's different trusts that you can have to protect your beneficiaries. So remembering that wills only deal with assets in your sole name or superannuation that's paid to your estate after your death. So for Brian, who's fairly stable with no asset protections, we want to give him some tax advantages so that, you know, his inheritance income doesn't all end up in the tax office. For Carol, she might have gone guarantor for someone in a business, or she might be at risk of bankruptcy. We don't want her creditors to be able to get her assets if she did go bankrupt. Michael might be looking down the barrel of a divorce, and we don't want his ex-spouse to get his inheritance. Paul is a gambler, so we might want to protect Paula from herself, so that her inheritance doesn't end up down the racetrack. And then there's William, who might have an intellectual disability, and not only do we want to make sure it's managed for his benefit, but we don't want him to lose his pension. So there's different ways that trust can be used in your will to make sure all these beneficiaries are protected, and that they also get the best tax outcomes as well when they've got their inheritance and they're investing it. And then lastly, I just want to talk about powers of attorney, because that's something, obviously, when we're talking about assets and who's going to control our assets, knowing who's your financial power of attorney and appointing the right people is going to be an important decision. So in most states, they're all a little bit different, but generally you can appoint a number one attorney and then have alternates like backups. And the decisions that they'll be able to make are buying and selling your assets, paying bills, managing investments. So quite strong powers, pretty much doing everything that you could do. But think they also could end up in control of your companies and family trusts, and if you've got self-managed super funds. So all those other structures that you might create along the way. So think about, you know, do you want one power of attorney that deals with everything, or do you want to separate your powers of attorney so that one person is dealing with business assets and one person's dealing with more personal assets? So they're the sorts of things that we can help you with at Avant Law, with your succession planning and your business structuring. So thanks for listening. And right now I will hand you back to Jackie.
Thanks so much, Jen. That was really interesting. Note to self, we all need a will and we all need a trust or two. Okay, so we've probably had close on 50 questions, which is amazing. I'm going to try and pick out some for our Q&A now. So let me see. Jordan, should I prioritize paying off my mortgage or voluntary HEX contributions?
Okay, that's a tricky one because it's very dependent on the doctor's personal situation as well as their goals over the foreseeable future. So generally, when our doctors are deciding which debt to focus on paying down first, we would recommend starting with the most expensive rate and working backwards. So with HEX having been indexed at 7.1% in June this year, which was very painful if you had HEX, and the average home loan being at around 6% at the moment, majority of our doctors, from what we've seen, have been focusing on paying down their HEX. Now, there are different ways for them to do this, so it's important to speak with your advisor or accountant first. What we're seeing a lot of our doctors doing that do have home loans is putting their extra payments into their offset account, and then they'll likely pay out their HEX in a lump sum before indexation or end of financial year next year. So I would say have a chat with your lender or your financial planner or accountant, and they'll be able to guide you on how best to do that.
Fabulous. Thank you, Jordan. Okay, let's try one for Katia. How should I structure my practice to ensure that my income is on par with my male colleagues?
Lovely. So how long's a piece of string? There's a lot of different ways, but I feel like the first one is to have a discussion with your accountant and make sure you've got some industry information around what key benchmarks would be for your particular type of modality in the area that you're looking to work in as well. So it's a best way to start is your accountant, though, because they have full access to all the different medical practitioners that they assist, and they have an idea of what they are billing and what the average would be. And if you're looking to bill less than that, that's their job. They're going to tell you. So if you're not sure if you're getting the right amount of money for the very important work that you're doing, then get an opinion from someone who is across the industry in a lot of detail.
And Kate, on that point, because I've seen a lot of questions come through for people asking, do we have contacts? Could we put people in touch with accountants, financial planners? people would just send us an email and ask for that, because I know I just saw some of the questions. Kath had said put some information in or send out it privately, but I don't think there's a private function, right? So easiest is to email us. We've provided some details, but we will at the end of the session as well. So please do send us. We've got a few people that we can send our clients to. Okay.
Yeah, just to point out, sorry to interrupt you, Jackie. No. Every state, every city is different in terms of who our contacts would be. So, and sometimes the contacts might be different depending on what you're looking to achieve. I know the accountants that I know, some are more commercially based, whereas others are more, you're in a public hospital. So your needs are very different from someone who's running an entire practice. So it's good to connect with us, but it'd be good for us to have an understanding of what your needs are. So we're not sending you on a bit of a wild goose chase to speak to a few different people that may not be the right fit. Yeah.
Perfect. Thank you. Okay. Jen, when should we women look into wills, etc., to plan for retirement and the future?
Thanks, Jackie. I suppose any time you have assets, it is a time that you probably need a will. And even if you haven't got a house yet, most of us have still got some sort of superannuation. And with that superannuation often comes life insurance. So even at the minimum, once you're sort of starting to work, you've got a good couple of $100,000 that would form part of your estate if you died. So if you're interested in making sure that goes to the right people that you care about, then you need to get a will. Even if you don't have a will and it just goes in accordance with the legislation that's relevant for your state, it's usually more complex and costly to not have a will in place. If you die what's called intestate, so without a will, it's usually more complex. Yep.
Okay, perfect. And while I have you on screen, is setting up a discretionary trust necessary to protect my assets, both medically, legally, and in the event of a relationship breakdown?
So family trusts are very good from a bankruptcy asset protection point of view, and they're also good in being able to spread the tax load across some of these beneficiaries, depending on who you've got in your network, your structure. When you've got spouse, children, or companies that income can be diverted to it, company tax rate if you're on a higher tax rate. From a relationship breakdown point of view, they're not bulletproof against the family court. So again, it's about, if you want to protect them, it's about having that binding financial agreement in place if you've got a family trust that you're wanting to protect. Yeah.
Okay, got it. Jordan, is it better to keep money in an offset against a home loan or put it towards an investment?
It's a good question as well. So again, it really, really depends on our doctor's personal situation and goals. And I can't stress how different every single doctor's situation is. Because if I was speaking to a doctor that had a life change coming up, so say they were going to have their first bub or they were about to start their own private practice, it's likely that building up their savings is going to be their key priority, because there's going to be cash flows and other costs that we're considering that we would rather have something in the kitty to pay for. Whereas if you were a doctor who was well established and steadily earning income, you had your property, no real massive plans for the foreseeable future, that might be the right time to look at diversifying some of those funds into an investment, be it stocks, shares, or property. The person that's going to be able to provide you which option in that respect you should be looking at probably be your financial advisor. And then from there, they'll direct you to your accountant for tax implications, as well as us or your financier for what you need on the lending side. So I would recommend having a bit of a think around which stage you're at, and then having a chat with your MVPs so your team can guide you and then you can make an informed decision.
Jordan, you have to tell us what MVP stands for.
Well, it's your most valuable players. So very, very important people to have in your corner.
That's it. Fabulous. Okay, and I think we probably have time for one more. Kate, I currently have some lending for my practice. Should I keep all my lending with one provider, or is it worthwhile reviewing options and splitting my banking in line with my home loan / personal banking?
Well, ordinarily, the preference, if you're looking to take out lending for your practice is we try to keep it as separate as possible from your home loans and your personal assets. And it's a big part of what Jen was talking about, is having the correct structures in place. I guarantee you, and I've seen it over the years many times, the more you have with one lender, you may have them separated at first, but suddenly you want to get a little bit of a top up, or you want to get an extension on your loan. We can approve it, but we just need your house. And that happens over years. And then you find that everything is intertwined. It's impossible to move. You find yourself on not very preferential financial restrictions around what you can do, what the repayments are, the interest rate. It's really difficult to move. So we do like to keep them separate, because commercial's commercial, residential's residential, and it's much easier if you can refinance them separately. And yes, having multiple lenders is definitely an option, and I would actually actively promote it, because you don't want one bank having full visibility over everything that you do. I've had some very strong clients that I've looked after where they had everything with the same lender, and they were aware of them being a part of a larger practice, and they were aware of what the other practice was doing. So they were reviewing their partners and what their practice overall was doing before they'd approved my client. It was a very strong client. So it's those types of things, considerations, that can really play a part. And it's not held against you if you have split banking. You don't have to have everything with the one lender. And with the way modern day banking is with real-time transfers, there's no real hindrance if you're doing transfers and things between different lenders. I feel like it's a good protection mechanism, and I actively promote it. Yeah.
Okay. Excellent. Okay, well, thank you, ladies. I think that concludes our first webinar in the Finance Matters series. We'll be sending out a post-webinar survey and would really appreciate your feedback, as well as any topics you might want us to cover next time. I'd also like to thank all of our lovely presenters and you, our audience, for making the time to spend with us this evening. I do hope you have enjoyed the session, and if so, please don't keep us a secret. We will be providing a link to this webinar, which we would love you to share with other female doctors, along with all of our contact details. So thank you, doctors. It's been a pleasure hosting you all tonight. Have a great rest of your evening, and good night.